If you own property in the UK, or you're planning to retire on rental income, what's coming down the road over the next couple of years could change your numbers more than almost anything else in the last decade. So let's go through it properly, calmly, and in plain English, and figure out exactly who this is going to hit, and how hard. Before we start, a quick note. Some of what we're covering today is confirmed law. Some of it is still speculation, and I'm going to be very clear throughout about which is which, because there's a lot of noise out there right now, and the last thing you need is to make decisions about your retirement or your rental portfolio based on a rumor dressed up as fact. Let's start with the one that's got the most attention, the mansion tax. Now, technically, that's not even its real name. The official title is the High Value Council Tax Surcharge, and it is genuinely scheduled to come into effect from April 2028. This part isn't speculation. This is confirmed. Under the current plans, if you own a residential property in England worth £2 million or more, you'll pay an additional annual charge on top of your normal council tax. The starting point is expected to be around £2,500 a year for properties between £2 million and £2.5 million, rising up to around £7,500 a year for the very highest value homes. Here's where it gets interesting, and this is where we move from confirmed fact into rumour territory. There have been reports suggesting the government could lower that threshold from £2 million down to £1.5 million. Now, this has not been confirmed by number 10. I want to say that twice, because it matters. It has not been confirmed. But it's worth understanding why people are talking about it, because if it did happen, the impact would be much bigger than people realise. A £500,000 drop in the threshold doesn't sound dramatic on paper. But when you actually look at the property market, it could bring somewhere in the region of 150,000 additional homes into scope. That's not a small adjustment. That's nearly doubling the number of properties affected. So who does this actually hit? The obvious answer is homeowners in expensive parts of the country, particularly London and the southeast, where £1.5 million buys you a perfectly ordinary family home in a lot of postcodes now, not a mansion with a swimming pool and a wine cellar. But here's the group that really needs to pay attention, and it's one that gets overlooked in most of the coverage of this topic. Retirees who bought property decades ago. Think about it this way. If you bought a house in London or the southeast in the 80s or 90s, you might have paid what felt like a huge amount of money at the time. But by today's standards, it was nothing. Decades of house price growth later, that same house could easily be worth well over £1.5 million. You didn't do anything to make that happen. You didn't get a pay rise, you didn't win the lottery, the market just moved around you while you were living your life. And now, on paper, you're sitting on a mansion tax liability, even though your actual income in retirement might be a fixed pension that hasn't moved much in years. This is the trap with property taxes generally. Income tax rises because you earn more. Property tax can rise because an asset you already own becomes more valuable on paper, while your actual day-to-day money stays exactly the same. For a lot of retired homeowners, that's a genuinely uncomfortable position to be in. You could be asset-rich and cash-poor and suddenly facing a bill of thousands of pounds a year for owning the home you've lived in for 30 or 40 years. Now, if you're a landlord, this applies to you as well. And it comes with an extra layer of complication. A lot of people assume that if a rental property gets hit with this charge, it simply becomes another cost that gets passed straight on to the tenant. Based on what's been proposed, that's not quite right. The charge would land on the landlord, not the tenant. Whether the landlord then tries to recover some of that cost through higher rent further down the line is a completely separate question and not a guaranteed one. And for landlords, this new charge wouldn't be arriving in isolation. You've already got mortgage interest restrictions, maintenance costs, insurance, licensing requirements in certain areas, and what can sometimes feel like a new compliance rule appearing every few months. Adding another annual bill on top of all of that could be the thing that tips a marginal property from profitable to barely breaking even, particularly for anyone who was already working with thin margins. The government's own estimates for the current £2 million threshold suggest the surcharge could raise several £100 million a year. If the threshold does get lowered, both the number of people affected and the total revenue raised would increase significantly. Whether you think that's a fair way to raise money or not is a separate debate entirely, but the direction of travel is worth understanding, regardless of your opinion on it. Higher value property is becoming one of the more attractive places for government to look when it needs to raise money, and that's true whichever party happens to be in charge at the time. Now let's move from speculation to something that is 100% confirmed and already happening, because if you're a landlord, this is arguably a bigger deal than the mansion tax could ever be. Section 21, the no-fault eviction, is gone. For decades, Section 21 was one of the most important tools a landlord had. It let you regain possession of your property without having to prove the tenant had done anything wrong. You served the correct notice, followed the process properly, and at the end of the notice period, you could ask the tenant to leave. No explanation required. That's why it became known as the no-fault route. Under the Renters' Rights Act, 2025, Section 21 was abolished from the 1st of May 2026. That's not a rumour, that's the law as it stands right now. All new tenancies are now periodic tenancies, with no fixed end date. In practical terms, that means a landlord can no longer simply decide, I want to sell this property, or I want to move back in, or I'd prefer a different tenant, and use Section 21 to make that happen. Instead, landlords now have to rely on specific legal grounds under Section 8 of the Housing Act. These grounds cover situations like wanting to sell the property, needing to move yourself or close family into it, serious antisocial behavior, or a genuine breach of the tenancy agreement. The key difference is you now have to prove the ground applies. It's no longer automatic. And this is already creating knock-on effects that weren't necessarily part of the original plan. Letting agents are starting to report more prospective tenants showing up with county court judgments, CCJs, linked to previous tenancies. Here's why that matters. If a tenant falls behind on rent, the landlord goes through the courts to get possession and to pursue the unpaid money. If the debt isn't settled, the court can issue a CCJ. Most landlords and agents run credit checks before agreeing a new tenancy, so a CCJ doesn't just affect the tenancy it came from, it follows that tenant and makes it harder for them to secure their next home too. That creates a second problem. If more prospective tenants are being ruled out because of a CCJ on their record, landlords are left choosing from a smaller pool of applicants. That can mean longer void periods, fewer suitable tenants coming forward, and some landlords having to think hard about whether to relax the referencing standards they'd normally apply. Nobody really comes out ahead here. Tenants with a CCJ struggle to find their next home, and landlords have fewer qualified applicants to choose from. It's early days for this particular consequence, but it's one that parts of the industry are already flagging. If you're a landlord and you served a valid Section 21 notice before the 1st of May 2026, there's a deadline you need to know about. You have until the 31st of July 2026 to make a possession claim through the courts using that notice. Miss that date, and the notice becomes worthless. If that applies to you, and the clock is already running, that's not something to leave until next month. Step back for a second and look at the wider pattern here. Tighter energy efficiency requirements. Greater tenant protection. Increased enforcement powers. Now the end of Section 21. Landlords have been dealing with a steady stream of new regulation for years now, and the general feeling from a lot of people in that position is that just as you get your head around one change, the next one is already on its way. Which brings us to the bigger political question. What might come next, and who's likely to be driving it? Andy Burnham has become a name closely associated with this conversation, partly because of speculation about a future role in national politics. Now, to be completely fair here, nobody can say with certainty what Burnham would do at a national level unless and until actual policies are announced. Being a mayor and being a prime minister are very different jobs with very different powers. But if you want a clue about someone's general approach, Looking at what they've already done, with the power they do have, is usually a pretty reliable indicator. And Greater Manchester gives us a genuinely useful window into that. One thing stands out consistently: a clear focus on raising standards and increasing enforcement in the private rented sector. As Mayor of Greater Manchester, Burnham has backed a number of policies aimed at improving conditions in rented housing. The best-known example is the Good Landlord Charter. Despite the name, this isn't a legal requirement, and it doesn't replace existing landlord law. It's a voluntary scheme designed to encourage higher standards, reward landlords providing good quality housing, and make it easier to identify the ones who consistently fall short. Most landlords, if we're honest, would probably agree that nobody wants rogue operators giving the whole industry a bad name. According to figures from the Greater Manchester Combined Authority, the Charter now covers roughly half of all rented homes in the region, with more than 34,000 properties covered through registered supporters. But the Charter is only one side of the picture. The other side is enforcement, and Greater Manchester has taken a noticeably tougher line here. Over a 2-year period, enforcement action against poor landlords resulted in £1.47 million in civil penalties, with the number of enforcement fines increasing by 43%. To put that in context, these penalties weren't handed out simply for owning rental property. They were targeted at landlords who'd committed housing offences or were providing substandard accommodation. And again, if we're being fair, most people would agree that if someone is renting out genuinely dangerous or unacceptable housing, there should be consequences for that. Burnham himself has repeatedly drawn a distinction between good landlords and rogue landlords, with the general message being that good landlords should be supported while those providing unsafe housing should face much stronger consequences. But he's also spoken about going further, backing stronger powers to deal with landlords who repeatedly fail to fix serious issues. One proposal that's attracted particular attention is a 3-strike style approach, where landlords who repeatedly fail to address serious problems could face much stronger intervention, potentially including compulsory purchase powers in extreme cases. Now, again, context matters enormously here. This isn't about the average landlord losing their property. It's specifically aimed at rogue operators who keep ignoring enforcement action after it's already been taken. But when you step back and look at the overall picture, a pattern does start to emerge. More powers for local authorities, more pressure on landlords to demonstrate compliance, and less tolerance for the small minority who repeatedly ignore the rules. None of this proves what Burnham, or anyone else for that matter, would do with national policy. But it does tell you that stronger regulation and greater landlord accountability aren't new ideas being floated for the first time. They're a continuation of a direction that's already been set at a local level. So with all of that in mind, what should you actually be doing about it, whether you're a landlord, a retiree with property wealth, or both? First, work out whether your properties are actually working for you, not just on paper, but in reality. It's incredibly common to be sitting on a property that looks like a huge success because it's doubled or tripled in value over the years, while the monthly cash flow has quietly been getting squeezed tighter and tighter. Ask yourself honestly, if you were starting from scratch today, knowing everything you know now, would you still buy this property? A property that made complete sense 15 years ago can look very different today once you account for mortgage rate changes, tax rule changes, rising compliance costs, and higher insurance premiums. Go through the whole picture properly. Rental income, mortgage costs, insurance, maintenance, letting agent fees, compliance costs, and tax. Someone who fixed a mortgage rate at 2% years ago is looking at a very different profitability picture now that they've had to refinance. Second, think carefully about how you actually hold your properties. This is one of the most common questions that comes up. Should property be owned personally or through a limited company? And there genuinely isn't a one-size-fits-all answer. If you own property personally, the Section 24 mortgage interest restriction is still a major factor. Individual landlords can no longer deduct all of their mortgage interest the way they used to, and instead get a tax credit based on finance costs, which has significantly increased bills for a lot of higher-rate taxpayers. Limited companies work differently, and in most cases, mortgage interest and finance costs can be treated as a normal business expense against corporation tax. But that doesn't automatically mean everyone should rush to incorporate. Moving existing properties into a company can trigger capital gains tax, stamp duty, additional property surcharges, legal fees, and mortgage arrangement costs, and plenty of people have discovered too late that the cost of transferring was far higher than they expected. This decision needs proper advice and proper numbers, not a general assumption, because the right answer depends on how many properties you own, whether you're buying more, your income, your long-term plans, and whether you want to draw the profits out personally or reinvest them. Third, get on top of compliance now, rather than waiting for someone else to force the issue. As enforcement increases, the landlords who tend to get caught out aren't usually the deliberately bad ones, they're the ones who simply let the paperwork slip. A certificate that wasn't renewed on time, a license application that got missed, records that exist somewhere but aren't organized. Most of the time, this isn't deliberate at all, it's just a systems problem. Make sure you've got a compliant tenancy agreement, up-to-date gas safety certificates, deposit protection completed correctly, any licenses required by your local authority, and proper records of repairs, inspections, tenant communication, certificates, and safety checks. If a dispute or an investigation ever happens, the landlord with organized paperwork is in a dramatically stronger position than the one relying on memory, and the best time to sort a compliance gap is before the council or HMRC ever has a reason to come looking, not after. To bring this all together, nobody can tell you with certainty what future property policy will look like, because a good chunk of what we've covered today is still rumour rather than confirmed government policy. The possible drop in the mansion tax threshold from 2 million to 1.5 million has not been officially confirmed. But if there's one thing worth taking away from all of this, it's don't fixate on any single policy in isolation. Look at the overall direction of travel. Property, and particularly high-value property, is increasingly somewhere governments look when they need to raise revenue, and regulation around renting is only getting tighter, not looser. If you found this useful, it would genuinely help to share it with anyone you know who owns property, whether that's a fellow retiree, a landlord, or someone planning ahead for their own retirement income. And if you'd like more videos like this one, breaking down what's actually happening with UK tax and property rules in plain English, without the jargon and without the political noise, make sure you're subscribed to the channel so you don't miss the next one. Thanks for watching, and I'll see you in the next video.